Hello, welcome to the European Open briefing for Tuesday, April the 4th. I'm Rafi Boyajian, currency analyst at xm.com, and we're going to be having a look at what's happening in the currency markets today. So there's quite a bit of risk aversion in the markets this morning. The dollar has slipped back below the 111 yen level, despite some fairly solid US data out yesterday. It's pretty much the case of investors sitting on the sidelines ahead of that all-important meeting between the US and Chinese presidents later this week, as there's a lot of debate on whether they will agree on trade policies, as well as recent concerns about North Korea's nuclear or missile testing activities. Also, we had that explosion on the St. Petersburg underground yesterday, and that also dampened market sentiment this morning as well. In terms of currencies, DOZ is one of the bigger major currencies that's bigger droppers in the major currencies. We had the RBA meeting today. They kept interest rates at 1.5%, although their statement was a little bit more dovish than what was expected. So we saw the Australian dollar slipping to 3-week lows. In commodities, gold is benefiting from that risk off mood. It's up at 1-week highs, although oil it hasn't benefited much from the weaker dollar, as we've had a rebound in the Libyan output, which was disrupted last week, and of course ongoing signs of the rising US production that's weighing on the outlook. But looking now at the dollar-yen pair, we can see the dollar has been steadily falling this week. It's currently trading around 110.40 yen. Of course, we've got the President Trump and President Xi meeting on Thursday and Friday, where markets are waiting to see what they will talk about and what they will agree on. There's fears of a protectionist stance by the US on trade, as well as security concerns regarding North Korea. We had good data out of the US, although traders appear to be ignoring that. We had the ISM manufacturing PMI, although it was slightly down from February's 2.5-year highs. It was still, it did beat estimates, and it was still near those 2.5-year highs. So overall, it's showing that manufacturing sector continues to do well in the US. Construction sector also appears to be doing well. Construction spending rose to an 11-year high, but vehicle sales disappointed last month, so that kind of maybe mainly weighed on automobile stocks, but overall the overall impact was positive. But as I said, the main focus is on the risk aversion that's weighing on the markets. The Australian dollar is down around 0.5% against the US dollar. It's currently trading around 0.7563. The RBA held rates at 1.5%, but they did express some concern about softer conditions in the labor market, as well as uneven house price growth. That's slightly more dovish comments than in the previous meetings that we've been getting used to, which were much more neutral. Although the RBA is still concerned about high household borrowing levels, this does raise the prospect that potentially, if tighter lending measures do rein in record borrowing levels, then potentially we could see a rate cut if the economy continues to weaken. Having said that, Australia's trade status is not too bad at the moment. Its trade surplus surged in February, but despite that, the Aussie is struggling at 3-week lows. Let's move on to commodities now. We can see oil has slipped close to the $50 a barrel level. This comes after we had a resumption of Libyan output after last week's disruptions had actually pushed up prices, and of course US oil rigs count went up on Friday, plus market outlooks in terms of analyst outlook and so on. They seem to point to rising production in the US, apart from the what we're seeing from the oil rig count, so that's weighing on the market. And in gold is doing much better because of that risk aversion. It hit a 1-week high, $1,258 an ounce earlier today. In European currencies, both the euro and the pound are struggling. They're both down sharply against the yen, and they haven't benefited much from the weaker dollar because they are moving down alongside with the dollar. We did have strong Eurozone manufacturing PMIs out yesterday. The Euro-wide PMI rose to a 6-year high of 56.2 in March. It was final reading. But despite that, the euro is down. It's currently trading around $1.0650. The main reason for that is, apart from that weak inflation figures we had last week, German bond yields are lower because of the risk aversion. That's increased demand for German bond yields are safe havens. So the increased demand for that has lowered the yields on German bond yields, and that's been negative for the euro. The pound, meanwhile, we saw weaker than expected manufacturing PMI for the UK yesterday, which missed estimates and was down from the previous month at 54.2. So that's basically dragged down the pound, which is currently trading at 1.2432. And a quick look at the South African rand, because it has been the worst performing emerging market currency over the past few days. It dropped a further 1% today to 2-month low of 13.94 per US dollar. The currency came under pressure after the president sacked the country's much respected finance minister in a cabinet reshuffle, and the new finance minister is seen as likely to increase government borrowing. So that led to the rating agency S&P to cut the country's credit rating status to junk, and that obviously has been very negative for the rand. It's going to be a fairly quiet day in today's economic calendar. We've got Eurozone retail sales figures coming out and UK construction PMI. In the US, we're going to have the US trade data as well as factory orders. But we're also going to have a couple of central bank speakers. RBA Governor Philip Lowe is due to speak shortly, and the Fed's FOMC member Daniel Tarullo will speak later in the day. That's it from me. Thank you very much for watching, and have a great day.